Hey folks, welcome to Concept. Welcome back to yet another video. In this video we will learn about horizontal spreads, wherein we will first understand what are horizontal spreads, and then specifically we will learn about a strategy which is calendar spreads. So calendar spreads is one of my favorite strategy, wherein we will talk about calendar spreads and understand how the strategy is designed and what is the real purpose if I am doing something like calendar spreads. So do watch the video till the very end. So to start off with, just to explain you what are horizontal spreads, so let me just take you to option chain. Now horizontal spreads are basically strategies wherein you are creating different legs and different expiries. So let's say if I buy 19650 of this expiry and I sell this one 19650 of the next expiry, that is a horizontal spread. Let's say if I sell 19650 of the next expiry, or buy 19650 of the next expiry and sell the current 19650 strike price call option, then again that is a horizontal spread. But when I'm actually selling 19650 of 19th October expiry, that is the closer expiry, and if I'm buying 19650 of the next expiry, that strategy makes a lot of sense to me. Now why does it make a lot of sense to me? The reason is the theta decay. Now when we are trading in market, we actually just focus where the market is going to go instead of actually focusing on the variables or focusing on the things that are affecting my option premium, things that are easily predictable. So now time is something which everybody can predict, and the strike rate would be 100% because the time is going to flow away, right? Now if you see the theta decay for the far away expiry, which is 26th October expiry, that is minus 7.88. so what does it tell you? It tells you that if you remain in this strategy, 7.88 rupees is what the time will take away from this premium. Okay, now if I just show you 19th October expiry, now what is the case over here? The same strike price, but just the expiry is different. The theta decay here is 25.45. that means this will decay by 25.42 rupees, and the other one, the next expiry, will decay by 7.8 rupees. Now this is because we are getting closer to the expiry. So learning number one, more closer we get to the expiry, more faster the theta decay. So to tackle that, to tackle the difference between them, I created a simple strategy. I sold the current one where the theta is decaying faster, so it is giving me quicker money. Now the other one, the 26th October expiry, it is taking away theta away from me, it is giving me the theta hurt, but I'm not worried about that because the closer expiry, it is giving me much more better theta decay. So I am making 25, on front of that I am giving away 7 to 8 rupees to the theta decay. So net I am still making around 15 to 16 rupees of theta if I am doing something like this. So this is what we call a calendar spread, this is what we call a horizontal spread. So let me just show you in Architect why exactly I am doing something like this. So let's say custom strategy. So I'll sell 19650, 19th October expiry, right, and of 26th October expiry, same strike price, I will go ahead and buy. So now what is happening? The theta from this, which is the next series or the next week's this one call option, it is decaying slower, but this one, the current one, it is decaying faster. If you just see theta decay over here, so by the way, these are Greeks of these individual legs. So basically it is the theta decay multiplied by lot size of the instrument. So it is positional deltas and thetas, the positional Greeks we call it. Over here you can see the individual leg Greeks as well the entire strategy Greeks. Okay, so if I just want to see Greeks per unit, then I can do that. So now let's keep it to portfolio. So now basically portfolio is multiplying the lot size with the Greeks. Now over here if you see, I am making 1270 rupees roughly on this strategy's theta decay, right? So I am getting 1270 just to be in that strategy, but on the other hand I am giving 400, but still net if you see, I am still making roughly around 877 rupees over here. Now that is the first benefit. Okay, so what I actually did, I actually went ahead and benefited from the theta decay difference, what is happening across the expiries, right? So now over here the scenario is that not just theta, but one more thing what attracts me towards this is the Vega. Now if you see, despite this being non-directional strategy, okay, yeah, by the way I forgot, but if you just see, this is a non-directional strategy wherein you are not expecting the market really to move in any of the direction. Now if you see, if the market remains in this range, you are going to make a decent amount of returns. So now more closer we do this strategy to the expiry, I would say better it is. The reason is simple, the faster theta decay what is happening to the current leg, to the current expiry. Now that's that. Now coming to the Vega aspect, now see, even implied volatility would act like a risk for me, right, if I'm not doing it the right way. What I mean is, if I sell, let's say, call and put both, so it will also give me more similar kind of payoffs. First thing is, it will give me unlimited losses, and the other thing is, you know, if the implied volatility goes up, that strategy will give me a problem. You can come to Architect and you can try doing it and just move the IV slider over here, okay, just give the inputs, just change the IV. Let's say IV I'm expecting 10% down move or up move. So what I want you all to do is just move, create a short straddle first, sell a call option and sell a put option, and then try, you know, giving inputs that what will happen if the implied volatility goes up by 10%, okay, at the same level. You will get the result that, you know, the strategy starts giving you a loss. That is because of the Vega in that strategy. But over here you don't have that risk because, you know, the Vega of this strategy is positive. Now generally in low volatility environment, we expect that there would not be major movements happening in the market, and that's when this strategy comes into action. Implied volatility at lower levels, it tells you that participants are not expecting a bigger movement, number one. But you can't create a straddle here because, you know, implied volatility, if it shows its mean reverting characteristics, you will lose a big chunk to implied volatility there on a straddle. So now what you did, you actually created a calendar spread. Now even if the implied volatility goes up, then even you are getting the Vega benefit, the implied volatility benefit over here. So that is how the calendar spread comes handy. Now one last thing is, wherever I'm expecting the market to drift, so let's say if I'm expecting the market to drift towards 19,800, I will create the calendar spread at 19,800. That means I will sell 800 and I will buy 19,800, sell the current or the closer expiry and buy the far month or the far away expiry. And that is how easily using calendar spreads I can navigate to the markets in a much more better way and in a much more simpler way. So yes folks, that was it from my side. I hope you liked this video. Do hit the like button, do hit the subscribe button, and stay tuned for more such videos. Happy trading.